This is Barry Zalma on insurance. Today, I'd like to speak about identifying insurance fraud. Next to tax fraud, insurance fraud is the most practiced crime in the world. It is perpetrated by members of every race, religion, sexual orientation, and nationality. Insurance fraud is perpetrated by members of every profession. The temptation to commit insurance fraud is great because prosecutions are rare, convictions are more rare, and the convicted serve little or no time in prison. The possibility of a tax-free profit, coupled with the commonly held belief that it is not a crime or morally wrong to steal from an insurer, is often too difficult for normally honest people to resist. And those who are not normally honest, the criminal people, never resist the attempt to make profits from the crime of insurance fraud. In September of 2019, the Coalition Against Insurance Fraud, after reporting on the conviction of an insurance fraud perpetrator who was sentenced to probation only, asked, "What's wrong with the courts that won't send frauds to jail for a felony?" The answer is failure on the part of the government, the insurance industry, and the various departments of justice to educate the judiciary that insurance fraud is a major crime. The education effort must explain to the public and to the judiciary that every year the effect of insurance fraud runs to billions of dollars. It is estimated that insurance fraud takes between 3 and 30% of the premiums collected by insurers doing business in the United States. As a result, it drains $80 to $300 billion from the assets of insurers and similar amounts from government-supported insurance-type programs like the National Flood Insurance Program, the crop insurance programs, Medicare, Medicaid, Social Security, Disability, and Obamacare. Insurance fraud is not limited to the U.S. It happens in every country where insurance exists. For example, in the United Kingdom, insurance fraud is estimated to take £1.4 billion a year. In Canada, insurance fraud accounted for between 10 and 15% of premiums in 2009, or an estimated 1.3 billion Canadian dollars, in a country whose population is about the same as the county of Los Angeles. The Association of Certified Fraud Examiners estimates that the typical organization loss of 5% of its annual revenue goes to fraud. Applied to estimated 2009 gross world product, this figure translates to a potential global fraud loss of more than $2.9 trillion. The median loss caused by the occupational fraud cases in the ACFE study was $160,000. Nearly 1/4 of the frauds involved losses of at least $1 million. The Association of Certified Fraud Examiners also found that anti-fraud controls appear to help reduce the cost and duration of fraud schemes. It looked at the effect of 15 common controls on the median loss and duration of the frauds. victim organizations that had these controls in place had significantly lower losses than those organizations without the controls. Insurers should learn from this report that the best way to avoid insurance fraud is to act proactively with a fraud hotline, a professional staff special investigative unit, an SIU, and well-trained insurance claims personnel who can recognize the red flags or indicators of insurance fraud. Fraud reporting mechanisms are a critical component of an effective fraud prevention and detection system. The ACFE recommends that organizations should implement hotlines to receive tips from both internal and external sources. Such reporting mechanisms should allow anonymity and confidentiality, and employees should be encouraged to report suspicious activity without fear of reprisal. The ACFE study also found that occupational frauds, like insurance frauds, are more likely to be detected by a tip than by any other means, such as internal audits, external audits, or internal controls. In my career, a tip received by some executives at an insurance company that I represented indicated that one of its claims managers was taking a percentage of every contract issued to repair or replace damaged insured's property. And the fire reconstruction or water reconstruction contractors were obligated to pay between 5 and 10% of their contract amount to this manager. I was able to obtain a sworn statement from one of the manager's adjusters who was going through a 12-step program to get out of a drug problem and had a need to confess his wrongdoing. And this person explained to me how he worked with the claims manager, that he is the adjuster on the site, dealing with the contractor, would take 5% of the contract, and the manager would get 5%, so that the construction company would literally put an envelope with cash into the adjuster's pocket and into the claims manager's pocket at a business lunch, and go forward then with the contract, finding the payment of bribes to the claims manager, who was supposed to be protecting the assets of the company for which he worked, was a cost of doing business. I provided that report to the insurance company. They threw the sworn statements transcript into a credenza and instructed the claims manager who was defrauding them to no longer use the particular contractors involved. He served and continued to serve as claims manager until he passed away. And for some reason, I no longer received assignments from that insurance company to represent them as their insurance coverage lawyer. That is unfortunately a condition of life in the insurance world when dealing with insurance fraud, because nobody really wants to admit that they are victims of fraud. Most insurance frauds, unfortunately, succeed and are never identified. Many are for such small dollar amounts then even when identified, insurers decide it is better and less expensive to pay the minor frauds rather than refuse to pay or seek prosecution. Employee education, according to the ACFE, is the foundation of preventing and detecting occupational fraud. As a result, the state of California requires that all anti-fraud personnel, people who see claims, be trained annually to recognize insurance fraud. This by the California Special Investigative Unit Regulations, Title 10, Chapter 5, Subchapter 9, Article 2 of the California Code of Regulations. Many insurance fraud cases go unreported, either because the insurer victims do not recognize that they have been defrauded, because they choose not to report the crimes for fear of bad publicity, or simply because they do not want to deal with the expense and repercussions resulting from a refusal to pay a fraudulent claim. If insurers considered that 3 to 30% of their gross premiums likely go to perpetrators of fraud, they might be willing to invest more money in their SIUs and in fraud recognition training for all their claims personnel. Or, on the other hand, they would probably just raise premiums and take it out of the hide of those they insure. Those states that require that insurers maintain professional fraud investigation teams, the SIUs, attempt to compel insurers to investigate and defeat insurance fraud attempts by law, since they do nothing to defeat fraud without statutory compulsion. Applying the same formula to insurance and insurance fraud, based upon total $1.95 trillion in premiums collected, insurance fraud can be estimated at 3 to 30% of the premium collected a year in the U.S. alone, and over $5 trillion worldwide. Since insurance is the most popular and easy type of fraud to commit, insurance fraud is a major crime that hides in the shadows because the victims refuse to admit they are victims. Insurance fraud involves every type of insurance. It is not limited to claims padding. Insurance fraud is both a tort, a civil wrong, and in almost every state a crime, usually a felony. Black's Law Dictionary defines fraud as, quote, an intentional perversion of truth for the purpose of inducing another in reliance upon it to part with some valuable thing belonging to him or to surrender a legal right. A false representation of a matter of fact, whether by words or by conduct, by false or misleading allegations, or by concealment of that which should have been disclosed, which deceives and is intended to deceive another, so that he shall act upon it to his legal injury. Close quote. In simple American, insurance fraud can be defined as a lie told for the purpose of obtaining money from another who believes the lie to be true. Civil insurance fraud exists if an insured 1. Makes a representation to the insurer that the insured knows is false. 2. Conceals from the insurer a fact he or she knows is material to the insurer. 3. Makes a promise he or she does not intend to keep. For example, I will sweep the grocery store floor every hour, I will regularly patrol aisles in search of the degree, or the premises is protected by sprinklers. And 4. Makes a misrepresentation on which the insurer relies in issuing the policy, and the insurer is directly damaged as a result of the lies. To protect insurers against fraud, most insurance policies contain, in clear and unambiguous language, a clause similar to the following, quote, "This entire policy shall be void if, whether before or after a loss, the insured has willfully concealed or misrepresented any material fact or circumstance concerning this insurance or the subject thereof, or the interest of the insured therein, or in case of any fraud or false swearing by the insured relating thereto." Close quote. This is California Insurance Code, Section 2071, the standard California fire insurance policy. This video was adapted from my book, Zalma on Insurance Claims, Part 109, Second Edition, which is one part of the 10-part treatise, Zalma on Insurance Claims, all of which are available as both Kindle books and paperbacks from Amazon.com. If you found this video to be useful or interesting to your colleagues, please pass it on. It's free. And please also subscribe to my YouTube channel, my Rumble channel, my Substack report, or my blog so that you can learn of future blog postings and future videos. Thank you for your attention.